Substantive procedures. A client has approached the auditors, presenting them with the job to audit his company. The auditors begin the planning phase of the audit. They begin by examining the inherent and control risks of the company. Control risk and inherent risk are high. This means that there is a higher chance of material misstatement in the financial statements due to errors or failure in the operation of relevant controls. Because of this, the auditors must reduce detection risk. This means they will increase the number of sample transactions for detailed testing and take a more substantive approach. Inventory check. The primary reason for auditors to observe their client's physical inventory is to make sure that the inventory reflected on the balance sheet actually exists. Here the auditors are counting the inventory the client stores at his shelves. After gathering the evidence, the auditors now compare the inventory to the balance sheet. They also make sure that the balance sheet includes all inventory owned by the company. Confirming the existence of inventory through observations also addresses the occurrence and completeness assertions. Checking with the bank. Here the auditors investigate the loans and cash assets on the balance sheet, comparing this with the official statements from the bank. By doing this, they are able to identify any errors or misstatements within the financial reports. This also addresses occurrence and completeness. Now the auditors are matching customer orders to invoices billed and collected funds to invoices billed. They do this by comparing the receipts they have with numbers on the financial report. They also make sure that transactions and events have been recorded in the proper accounts and that transactions and events have been recorded in the correct accounting period. This complies with the cutoff and classification assertions. Assessment of fixed assets. This test is very similar to the inventory check. However, now the auditors are observing fixed assets instead of inventory. In this case, they are observing a printer. The auditors must check whether the machinery is functioning and in good repair and well looked after. This evidence determines whether assets should be written down below the current book value or written off. This addresses the valuation and allocation assertions. Recalculations. This is a very basic test that consists of the auditors checking the mathematical accuracy of documents and records. This can be performed manually or electronically. This addresses the accuracy assertion. Computer-assisted techniques. This is the practice of using computers to automate the audit process. All the client's data will be inputted to the computer. Special audit programs can now be run. These programs will quickly check for any errors in simple additions. However, more complex additions will need to be done by hand. Once the auditors have gathered enough relevant evidence and have fully analysed information gained from substantive testing, they are now able to give an opinion. In this case, the auditors have given the client an unqualified opinion. This means that the financial statements give a true and fair view in accordance with the financial reporting framework. This is the best type of report a client can receive from an external auditor.